a very warm welcome to this week's mortgage market update. I hope everybody is super well and feeling slightly shady after a night of celebrating England's incredible victory against Germany in the European Championships. Well done, England. I promise this will be the last football reference I make today, but what a great outcome for us. Now look, in terms of what we're going to cover off this week, more lender changes. There's still lots of repricing going on as lenders look to jostle to compete on price to attract new business. I think it's fair to say that lenders were awash with applications in the prior months with regards to the mortgage market being super busy and people looking to complete on housing transactions with the stamp duty holiday, and more on that in a moment as well. But I think that as they're looking at the lending volumes that are coming in now, things are certainly starting to quieten down. So really revisiting their portfolio of products and looking to see how they can look to ensure a steady flow of new business going forwards. We're also going to touch on this week, just briefly, rental yields and house prices. It is going on. I know we talk about it every week, but it is actually really relevant to people who are thinking about investing. And then lastly, we're going to just cover off some thoughts really of mine in terms of what interest rates are going to be doing over the coming few months. So LendInvest have bought out a couple of semi-exclusive mortgage products. Now, a semi-exclusive product means that it's only available to a selected number of brokers, and we are fortunate enough to be one of those. So thank you very LendInvest for having us on board. Now, the rates that they've released are available for a limited period of time, and they're actually very good. So looking at these rates and the portfolio of products that LendInvest offer in the round, their pricing now starts on 2-year money from 2.85%, on 5-year money 3.04%. So in terms of who a LendInvest borrower is, LendInvest are able to lend to limited companies and individuals. Generally speaking, with the limited company piece, they can lend on layered companies, so it's something that's a little bit sort of more quirky, but nothing too racy for these guys. Now, you can have up to 20 properties or £3 million worth of borrowing with LendInvest, whichever comes first, but you can have an unlimited number of properties in the background. Their minimum property value is £75,000, which is actually quite important because a lot of the limited company lenders particularly will have a minimum property value of in excess of this. Their minimum loan amount is £50,000. To apply for a mortgage with LendInvest, you can be no younger than 21 years of age, if only, and no older than 80 at the point of application. Now, LendInvest don't have a minimum income requirement unless you're applying for an 80% loan-to-value product. The pricing that I've just referred to is not at 80%, I'd hasten to add. That's a bit higher. But no minimum income requirement if you're borrowing up to 75% loan to value. They can do remortgages from day one of ownership, so you don't have to wait for 6 months to remortgage with these guys. You are able to overpay by up to 10% per year. We've mentioned this in previous videos, but not all lenders allow this. And actually, it's a facility that borrowers really like to have. I don't know how often people actually really do use it in reality. But I think we all like the idea that we would, want to start paying chunks off of our mortgage, and with LendInvest 10% is available, which is really good. Now with LendInvest you are able to obviously let the property on a standard AST, but they will also accept corporate tenants of up to 1 year and also DSS tenants. Now with LendInvest they're not able to accept let to buy applications, so that would be where you are remortgaging your home and putting it on a buy to let and then doing an onward residential purchase. And they're not able to accept consumer buy-to-lets. Now, the definition of a consumer buy-to-let is really would be mortgaging a property which was not acquired with the sole intention of renting it out. So if you inherited it, if it was your first home, that kind of stuff. So a few little restrictions there which would rule them out for some people, but in the main, still very healthy criteria, which most landlords would fit into very easily. Paragon have also released some limited edition products in the last week, 4 of them in total, which are available for both purchases and remortgages at 75% loan to value. Now what they tell us is that the products come with free valuations and £750 cash back. The deals are available for both single self-contained units and HMO multi-unit unit blocks. and are available for both personal and limited company borrowing. Now look, in terms of the pricing, it is really, really good. And when I explain the criteria and specifically understand why. So the rates for standard property now start from 2.75%, and for HMOs and multi-units, they start from 2.85%. If I told you that Paragon are able to finance on these kinds of rates blocks of flats of up to 20 units or HMOs of up to 20 bedrooms, you'll understand why I think the pricing is so competitive. You know, mortgaging a block of 17 flats on a rate of 2.85% is just incredible. So amazing from Paragon. Now, in terms of some sort of broader criteria, they do need you to earn £25,000 a year to have a mortgage with them. Like I said, they can accept limited companies. They are able to get their heads around layered company structures. That's no problem. They don't mind how many buy-to-lets you have in the background. In terms of their own exposure, they're willing to accept directly with Paragon. Realistically, they're able to go to really £2 million. They can go way higher than this, but then you get into the realms of having to have interviews. Now, I've had clients who've had interviews with Paragon before. It's nothing scary. They've actually found it quite enjoyable. But just to know that, you know, they can go beyond the 2 million, which is their published maximum exposure to any one borrower. They can accept let-to-buy transactions. They can do day one remortgages. They also accept those properties which are let to DSS tenants, corporate lets, and also housing associations, as well as your traditional ASTs. So a really, really solid offering from Paragon, bringing out some really, really fantastic rates. TSB have made some rate reductions on their remortgage products, reducing their 2-year fixed rates by 15 basis points. The pricing now starts from a really nice 1.59%. Now, with TSB on their remortgage products, there is a free valuation, and you also have the option for free legals or £300 cashback. In terms of TSB and the kind of borrowers they're looking to attract, so they're only lending to individuals. They do want you to have £25,000 a year worth of income. This cannot be from property. You can have additional income from property, but you have to have at least £25,000 a year that's not from property. You can have no more than 11 mortgage properties in the background. They do accept let-to-buy applications, and the thing that I feel that they're really quite very strong at actually is flats over commercial ex-local authority flats. So those kinds of properties where some of the high street would certainly bow out. These guys are quite happy to lend subject to valuers' comments. Foundation Home Loans have released 2 remortgage products which are available for limited companies and individuals. And at 75% loan to value, the rates now start from 3.19%, which is very, very good, particularly in the limited company space. Now, these products do have a minimum loan size of £200,000. There is £500 cash back, and there is a reduced arrangement fee of 1% of the loan amount. So particularly in the limited company space, I would say this is where these products really stand out. Now, in terms of Foundation Home Loans and the kind of borrowers they're looking for, so like I say, limited companies are fine. They can accept layered companies if needed. They're also very happy to lend to individuals as well. Foundation Home Loans only take for limited company applications personal guarantees from the directors. They're not really interested in the shareholders. This is particularly good where you have companies where you have, for example, lots of shareholders, maybe shareholders who are children who you simply don't want being involved in the application, having to offer a personal guarantee. It's also really good if there are more than 4 directors and shareholders combined, because most lenders can only cope with 4 applicants. Their systems simply just don't allow them to go any further than this. So if you had, for example, 2 directors of a limited company, so I don't know, mum and dad, but the shareholders were mum, dad and your 4 kids, God help you, then you would be able to go to Foundation Home Loans. They would only be looking to underwrite and take personal guarantees from the directors' mum and dad, so that can work really, really well. They have a minimum property value of £75,000. However, inside of London, it's £150,000. Again, I would be very pleased if you're able to find a property in London for £150,000. They can accept day one remortgages. You can be aged no more than 80 at the point of application. There is no minimum income requirement and no maximum number of properties in the background. Barclays have made a single reduction to one of their purchase products, which is available to 75% loan to value. So they're now offering a 5-year fixed rate with rates starting from 1.98% with a flat arrangement fee. When I say flat arrangement fee, what I mean is that it's a set amount rather than being a percentage of the amount that you're borrowing. They've also made some changes to their lending criteria where they're essentially saying that no single buy-to-let mortgage, the buy-to-let mortgage that you're taking out with them can be no more than 10 times your personal income. So if you earn £25,000 a year, the maximum they're ever going to give you on a buy-to-let loan is £250,000. Now, Barclays, they're a really good lender. Their pricing is really competitive. Actually, having said that, I was just having a look at their rates that they're offering right now, and they're not looking as keen as they normally do. But normally, in sort of more normal times, I would say that Barclays are one of the more competitively priced lenders. They're lending to individuals, not limited companies. Their criteria in terms of appetite to risk is fairly standard. So in that space, £25,000 a year minimum income requirement. They do consumer buy-to-lets. They will do let-to-buys. One of the things that stands out is they're quite good at short leases. They say they can accept ex-local authority flats over commercial high-rise, that kind of stuff. The thing that always puts me off with Barclays is that they don't really have a set rental calculation. Everything is done on an affordability calculation. So what would happen is that we as your broker would go to the Barclays website, we would key in various information about your finances. So for example, how much you earn, the expected rental income, details of any other buy-to-lets in the background. And some kind of magic happens and they come back saying either yes, this is affordable or no, it's not affordable. This works really well for those people who have one or two buy-to-let properties and really good levels of earned income and not huge amounts of personal unsecured borrowing in the background. For landlords with more than really sort of 3 buy-to-let properties, these numbers just don't tend to work out unless you've got a really kind of well-paid day job. The other reason that I don't particularly rate this approach, although I think there is certainly a place in the market for it, is that it just means that actually you never really know exactly where you're going to stand with Barclays. You kind of have to go in and fiddle around with numbers, which in itself is not a big drama, but you can never be 100% confident as to whether the numbers are going to work. So I think, in terms of where they are at the moment, the pricing is okay. It's nice to see they've brought out a new purchase product, which is fairly keen. The criteria really is okay for a certain kind of segment of the market. And like I say, there really is a place for this. But for your kind of more professional landlords, your more portfolio style landlord investors, this probably isn't going to be one that's going to be any good to you, I'm afraid. Kensington have made some reductions to some of their products, and now they have 2-year pricing starting from 2.99% and 5-year from 3.34%. Now, when they sent me through the kind of announcement about their new products, they also sent through a list of sort of USPs, as it were, in terms of their lending criteria. Now, I don't seem to end up using Kensington very often, and there's no particular reason for that. I think it's just that, I've never really needed to go to them, and their pricing is by no means the cheapest on the market. I mean, it's by no means the worst either, but actually it's never been quite there in terms of the deals that I've done, but there's no other reason for this. But I was reading through this list of lending criteria, or sort of USPs, and I was thinking, it's really quite good, which goes to show that every day is still a school day. So I'm going to share some of those with you. So first of all, they say they love professional landlords. They don't mind how many properties you have got in the background. They can accept let-to-buys. What they do say is will only assess the entity coming to Kensington. For example, if you're borrowing through a limited company, they're only going to be looking at the portfolio in the limited company. They've got no interest in anything that's held in personal names. They have rates of up to 85% loan to value. They can accept applications for people age 70, but there's no maximum term for those people, so essentially you can go to age 95. They can do blocks of 6 flats. They are able to accept people, and I like this, with credit wrinkles. So defaults and CCJs registered 24 months ago, and even those people who have been in a debt management plan. And another thing, which is really actually very niche, is they do lend on properties in Northern Ireland, which, particularly in the limited company space, is very, very unusual. And they also accept gifted deposits on all personal buy-to-lets, not limited companies. So a really, really interesting bit of, sort of niche policy there from Kensington, which I just thought I would share with you. Keystone have opened their doors to holiday let applications, and actually their offering is really, really good. So what they're saying is that essentially you can access holiday let mortgages via their specialist range of products. So essentially they're products which are also available for HMOs and multi-units. The way they're going to assess affordability is not based on the holiday let income. It's going to be based on a notional AST rent, which is actually very, very common for a large number of the holiday let lenders. Not all of them, I hasten to add. Now, in terms of the parameters that sit around this, they can lend up to £750,000 at 75% loan to value, and then up to £1 million at 70% loan to value. Now, Keystone don't normally have a minimum income requirement, but for the holiday let mortgages, you must be earning at least £40,000 a year. This can include income from letting of property. And you must also own one buy-to-let already, so they're not doing this for first-time landlords. Again, ordinarily you can apply for a buy-to-let mortgage with Keystone as a first-time landlord, but not when it comes to holiday lets. And one of the things that they've said that I think is really kind of key is that the letting can be nightly, so it doesn't have to be weekly lets, you can do nightly letting as well. So really, really solid offering, particularly when you take into account the fact that their holiday let rates start from 3.24%, which is really, really fantastic. Now, in terms of the broader criteria, this can be done on a individual or limited company basis. There's no maximum number of properties in the background. And Keystone are a lender who I think it's fair to say are they're very, very keen to lend money, and they do want to do deals, and they are able to look at things where there's something kind of peculiar in the background. So say, for example, a historic bit of adverse credit, maybe a slightly unusual company structure. They're really able to get their heads around these more complex transactions. So really, really solid offering from Keystone, and great to see them bringing some really competitive pricing into the holiday let market. Okay, so I'm recording this video on the 30th of June, which marks the end of the first part, as it were, of the stamp duty holiday ending. Thankfully, we've been able to get all of our clients completed in time for those who were aiming for completion pre the end of June. Thank goodness. So if anyone is watching this today and you've had a very last minute completion, congratulations to you. Now look, in terms of what this has meant for the house prices in the country and more broadly, so I was reading a report which was on the back of the Nationwide House Price Index, which has just been released, which tells us that annual house price growth accelerated to 13.4% in June, which is the highest outturn since November 2004. What they say is that while the strength is partly due to base effects, with June last year an unusually weak year due to the first lockdown, the market continues to show significant momentum. June saw the third consecutive month-on-month rise of 0.7% after taking into account seasonal effects, and prices are now almost 5% higher than in March. Regional data for quarter two indicates that all parts of the UK saw an acceleration in annual house price growth. Northern Ireland and Wales saw the largest gains at 14% and 13.4% respectively in quarter two. By contrast, Scotland saw the weakest rate of annual growth at 7.1%, closely followed by London at 7.3%. Now, Robert Gardner is the Nationwide's chief economist, and he has commented that the underlying demand is likely to remain solid in the near term. As the economy unlocks, consumer confidence has rebounded, and while borrowing costs remain low. This, combined with the lack of supply on the market, suggests further upward pressure on prices. But as we look toward the end of the year, the outlook is harder to foresee. Activity will almost inevitably soften for a period of time after the stamp duty holiday expires at the end of September, given the strong incentive for people to bring forward their purchases to avoid the additional tax. Nevertheless, underlying demand is likely to soften around the turn of the year if unemployment rises, as most analysts expect, as government support schemes wind down, but even this is far from assured. So I think really what we can take away from this is we aren't expecting house prices to come down this year for sure, and beyond the end of this year, it's really going to depend on how the economy performs. As important for us as landlords as house prices is also rental yields. And I read a report in the week which told me that average rents in the UK have risen to record levels of just shy of £1,000 per calendar month. So they're now sitting at £997 per month. And this is up by 4% compared to the same time last year. So according to the data from the monthly index, every region bar London saw a rise in rent prices year on year between May 2020 and May 2021, with average rents across the UK rising to £854 per month, pounds per month, up 6.4%, and that's when you're excluding London. 11 out of 12 regions monitored by HomeLet, who produced the report incidentally, showed a year-on-year increase in rental values, with both the east of England and southwest showing gains of over 8%. Really great news in terms of rental yields. I mean, it's one thing house prices going up, but if the rental yields aren't going up with them, or if the rents aren't going up with them, then the yields start to decrease. So it's really great that the rents are kind of plodding along behind and hopefully holding their own as well. I just want to share some thoughts with you on predictions for interest rates over the coming 12 months. And I think it's fair to say that when we're considering what we think interest rates are going to do, there's really two key factors at play. First of all, there's the cost of funds to a lender, so how much it costs them to essentially lend you the money. And then there's the margin that they want to make on top of that, so the profit. So first of all, when we consider the cost of funds, and that can be, there's lots of things that go into this, but when we just take each part individually in terms of what the lenders are facing. So first of all, the Fed has put its interest rates up. When we look at swap rates, 2 and 3 year swap rates have been increasing month on month. 5-year swaps are slightly down from May, but are still higher than they were in April. So that means that the lender's cost of funds bringing the money in essentially has increased if they're borrowing money in that way. Now, also we need to consider the Bank of England base rate, which currently is still, remaining where it has been for the last year. The MPC voted unanimously not to put it up in the last meeting. However, with inflation being as high as it actually is at the moment, it's obviously going to be on people's minds that interest rates, if things continue in the same vein, will potentially have to increase to kind of try and combat the really high levels of inflation. So looking at the external factors, actually, when you look at it in the round, the kind of indicators are pointing to the cost of funds potentially going up, and therefore there needing to be an increase in terms of interest rates. However, what we also need to consider is lenders' margins, because it's one thing what it costs them to lend you the money, but also then we need to think about how much they're going to add on top to make their own margins. Now, the lenders have had a really good run of it, particularly since the stamp duty holiday was announced back in last late summer, early autumn. The lenders have been absolutely swamped with business. And I think that has really allowed them to keep their margins relatively high, because, actually it's not been a pricing war as such. It's more been, the business has just been flooding in. But as we look to the future and what the housing market's going to do, whilst we've just been talking about the fact we're not expecting things to fall off a cliff, things will also start to slow down. So lenders need to be really mindful about attracting new borrowers in. And one of the ways that lenders will obviously attract new borrowers in is by reducing their pricing. And that means essentially taking a hit on the margins that they're making when they're lending borrowers money. So in terms of whether lenders will have the appetite to reduce their margins from where they are currently, I think that we're seeing it already with the kind of reporting that we're doing on interest rates coming down, or lenders' rates coming down. And I think there is still scope for things to come down a little further. However, I don't know if you will recall, but pre-COVID, we actually did see a couple of lenders just bow out of the lending market. They just said that actually the margins were too small commercially, they couldn't make the numbers work anymore. It wasn't worth them lending money because they simply weren't going to make any profit for doing so. And so there's a real risk that when there's a rush to the bottom on pricing, the margins become so tiny that lenders actually just say it's just not worth it. And are we there yet in terms of the margins? I don't think that we are. But also we are hearing, and we can see in terms of the way the pricing is coming down, that that lenders are starting to really squeeze things now, and there is going to become a baseline as to when things become, uncommercial for them. So I think in terms of, in summary, where we are, I think there is definitely a potential for interest rates to increase later on this year. I don't think it's going to be a huge jump, but I do think that the cost of borrowing will start to increase definitely as we get towards the back end of 2021. So this in turn really just leads me to think about what that means for you as the people watching this video and as potential mortgage borrowers. And I had a quick look. Now, obviously I'm going to talk fairly generally here because, everybody's situation is different, but we have buy-to-let mortgage rates for individuals starting from 1.19%. Now, I have been in the mortgage game for over 20 years, embarrassingly now, and I don't recall a buy-to-let rate of that level for, if ever, a very, very long time. So the pricing is absolutely incredible. Limited company rates now starting from 2.75%. These are pre-COVID levels of pricing, so the pricing is really, really good. So actually, the cost of funds is so competitive for you as a borrower at the moment. If you are thinking about remortgaging or even investing, the same thing applies. It's a really, really good time to lock in your mortgage rates. Now, when you do apply for a mortgage, your mortgage offer will be valid for between 3 and 6 months, which means that potentially you could apply for a mortgage now and not have to draw down on it until, or have the ability to not draw down on it until January of 2022. So what this really does is present an opportunity for you to secure funds at today's rates, but not have to utilise that money and capitalise or sort of lock yourself into it for a really long period of time, which is a really fantastic opportunity. So you have been warned. We do think interest rates are going to start to increase towards the back end of the year. The rates are really, really competitive just now. So really now is the moment to act if you are in the market for a mortgage in the next 6 months. Thank you, as always, for joining us. I hope you found that really helpful. Please do look after yourselves. We'll be back at the same time, same place next week. Until then, do enjoy the weekend. And if you have any questions, please do give us a call, 0345 345 6788, or by all means go and have a look at our website, mortgagesforbusiness.co.uk.